I hope you're all doing well. Welcome to the UK Stocks I'm Buying May 2023 edition. So this is what I do every month just to update you guys so you guys know what I'm buying or what I'm selling. Transparency, there's not many YouTube channels out there that do this, and I don't sell out anything quietly in the background. Anything that isn't working out, I just go, I'm just going to sell that in the background and hope no one notices that. There's none of that. Every month I update you with what I'm buying, what I'm selling, and today we're going to go through the UK stocks that I will buying and selling between the 1st of April to the 1st of May. So I hope this video is useful, and apologies the video is a little bit later than normal. The reason why just work's been absolutely mental, and combine that with earnings season, there's been a lot of conference calls to get through, so a little bit slower to put the videos out, but hopefully this video makes up for it. So hope you enjoy it, and if you're new around here, subscribe, and also if you could hit that like button because it does really help the video for the YouTube algorithm. Let's get started. And as always, if you want to know what I'm buying or selling in real time, the place to be is on the Patreon. You join through there, you get my live buy and sell alerts. As well as that, you get 2 exclusive videos a week. We're actually going to be doing a live Q&A session later today around 7 PM or 8 PM. So if you do sign up before that, you can catch that video and submit some questions. As well as that, you'll actually be able to catch the replay as well if you do miss it on the Patreon as well. And there's a Discord with 500 members to talk to about stocks, including me. Now let's get started onto these UK stocks I'm buying and selling. So first of all, if you want some free shares, join with the link in the description as well for Trader 212. But let's get on to the first one, Alpha Wave. So Alpha Wave is a stock that I used to own. I did sell out of the position. The reason why I did sell out of the position is because shares got suspended. The reason why the shares got suspended is because the auditor requested more time. Now, originally when I bought Alpha Wave, as most of you guys know, the big red flag that I had was with the management team. And the fact that the accounts were getting delayed was automatically a time for me to go, that is not good. And with my red flag being the management team, and I think this is a bit of a learning curve, you know, you're always trying to learn in the stock market, you know, the mistakes that you make, you always try and learn from them. One of the big mistakes that you guys that may be following the channel for a while was Tattoo Chef. I had so many red flags about the management team, and in fact it got to the point where I sold like 30% of my position in TTCF, which saved me from taking a big loss, but I still should have sold out 100% of the position when I had the red flags from the management team. So with that red flag and the share suspension, I thought I'm going to just take my cash from here. Took a bit of a profit, obviously not a major profit, nothing to brag about, but we did make some money on it. And since then the shares are still suspended. They've requested for more time. The CFO has also left, which is a little bit of a red flag. Seems like they were pushed as well rather than it was a by choice. So yeah, I'm glad I kind of took my money from this one and moved away from it. So yeah, most of you guys know about this because I did make a video on it. Now getting on to the buy-in. So most of you guys that maybe follow the channel for a little bit will know I've not really been active on the UK portfolio. I actually don't think I added any new positions into the UK portfolio in 2022. I was mostly focusing on the US market. So this year in 2023, I wanted to add some more new positions in. So there was a bit of that going on as well this month. So one of the newer positions that I've been buying is Money Supermarket. Now, the big issue I have with Money Supermarket is since I've started buying this stock, the stock has actually started going upwards. So I'm averaging up on this position. Now, I've got to the point where I don't want to buy anymore. So I'm praying this has a dip. I'm praying it has a dip into the £2.40, £2.20, £2 range would be perfect. And at 20 times earnings, it's a little bit rich. So I want to get it down a little bit lower. And also that hikes the dividend yield up. It's already attractive at 4.5%. But when you start talking 5-6% dividend yield, then it's even more attractive. So I did buy some, but the problem is it has been going up. So I'm kind of on hold on this one at the moment. And I'm actually hoping it to go down. A lot of people struggle with the concept of buying a stock and then actually hoping it to go down. You know, I want it to go down because in the long run, I think I'll make more money on that. So Money Supermarket obviously is a comparison site, car insurance, home insurance, travel insurance, all these sort of insurances here, which I think as well will do even more popular as well as, you know, the spending crisis, tightening's going on. People will want to try and make the most money they have by saving money on insurances, for example. And if you actually look at the recent financials have been absolutely amazing. A lot of this has gone off, as you can see here, the company grew 15% year over year. And that's as well without the one big part of the company missing. So they currently have the energy market missing from the business because of the whole price cap as well that's going on. So they lost this part of the business, and even with one of their big parts of the business lost, they're still putting in major amounts of growth as well going forward. And then you start thinking, well, you look at the energy price cap situation in the UK, that's probably going to go in the next coming 12 months. So you've got a company that's been growing insane on these parts of the business here, and then you have the energy part of the business that's going to be coming back. It's going to be very good on the financials. And you look down here at the financials at the moment, and you can see the drop in revenue since the whole price cap situation. And you can see here now they've got to a point where they're back growing, and this is without the price cap. If the price cap goes away, imagine the growth they're going to be putting in, and that profit will go back to levels that we're at. You know, previously you're going to be talking nearly 90, 100 million in profit. 90, 100 million profit, you know, you're going to be talking around 40 times earnings. You pick it up a 5% dividend yield, which obviously they'll hike up as soon as that energy price cap comes back as well. You're going to be getting a dividend that's even higher. Very, very attractive from that point of view. And it's a very decent balance sheet, as you can see here as well. You know, they've only got 20% debt to equity as well, which is really good. And as you can see here, the insiders have been aggressively buying up at the dip as well, which is really positive to see. So I think you look at the business here, and it's been performing so well without one of its main sectors. Its main sector is yet to come back. That comes back, your profit's going to jump up, your revenue is going to jump up. Trading at a cheap valuation, really lovely dividend yield. I think this is really attractive. The only issue is the valuation. I think you'd start talking around £2, £2.20, even maybe £2.40. I think, you know, when you get to them sort of levels, it looks really good on this company. So yeah, I'm a big fan of this one. I'd actually really like this to make it a big UK position, but to do that, it needs to come lower. So we'll see what happens there. Next one, S4 Capital. So I have been buying some more shares in S4 Capital. I really like this UK growth stock. It's a stock that I've owned for a while. Now, actually, when I started buying this UK growth stock, it was a really good performance. The shares went absolutely crazy. And then from that time frame, we entered the 2022 situation where, you know, marketing companies, fears about recession, everything like that, stock market crash, and it got absolutely killed. So the stock is down massively since that time frame. And then the stock actually started going up again. I was actually about break even at this point in time when we got to this point of view. And then recently, since February time, this stock has been taking an even bigger dip. So it's been quite a choppy process for S4 Capital since I owned it, but I still am very bullish on the long term of this company. Now, the digital advertising is going to carry on growing massively, even after this recessionary type environment that we've got going on here. Digital advertising, as you can see here, is nearly set to double in the next 5 years, which is absolutely crazy. So there's a massive room here for it to go. Now, why is the drop happening? Well, obviously the first drop was because everything went down. When you look at the share price of S4 Capital, this was a drop because the whole market absolutely sunk. Now, why did it start recovering with the whole market? And you know, everybody was buzzing at this time frame when this stock started going up, and then why is it suddenly dropped? Why is it back at kind of them peak fear levels of where we were at in summertime 2022? Well, you can actually pinpoint the drop here. And you can see here that Maxwell went for surgery on the 7th of February. And you can see here that was about roughly, let's zoom a little bit further in. That's about roughly where the stock actually peaked, as you can see here, and then started downtrending. Now, at this time frame, it didn't look like a major issue to us at the time frame. But as we know, sometimes the market learns or knows things that us retail investors don't know. And that seems to be very clearly the case, is that when we were getting told that Maxwell had gone in for surgery, what was actually going on is that Maxwell actually was having cancer treatment, and obviously he seems to be doing a speedy recovery, which is really good to see. But a lot of people are in S4 Capital because of Maxwell's history in this sector. He has been such a dominant figure in this sector, and everyone's kind of buying S4 Capital on the conviction that you look at his history, he's going to do it the same again at S4 Capital, and if he isn't there, what's going to happen then? And that's what's kind of spooked the market. And you can see here that that time frame when we knew he went in for surgery, the market obviously got a heads up that it wasn't for surgery, just for surgery. It was also good to treat cancer, and the worry were that he's not going to be around at S4 Capital anymore. And since that time frame, you can see here that's really beating the stock down. So, you know, that's obviously a factor that's kind of playing on the stock at the moment. But when you look at S4 Capital, financially, they're still doing very well at the moment. You know, in a really weak environment, the growth is still very, very strong at the moment when you look at the recent update. And hopefully when the marketing spend starts coming back and you look at the likes of Meta and Google, for example, and like the impact they're having from a weaker market environment, going forward, you know, if we're going to 2023, 2024, 2025, and we start seeing the recovery starting happening, and we start to see growth coming back at, I mean, they're already forecasting to grow 10%, but if we start talking 15, 20% a year, then obviously that growth is going to be really good. Obviously there's been a lot of cost because of the acquisitions, and obviously that should start leveling out on profitability profitability. But in the next kind of few years, we could see, you know, in the next kind of 2 years, you know, S4 Capital putting in 1.5 billion of revenue. You know, that would put it at 0.5 times sales, which is absolutely crazy. We could be talking nearly 100 million profit. That would put S4 Capital trading at like 7 times earnings. 7 times earnings while growing at like 15% a year, which is just is insane. And there's no doubt this company is in absolutely ridiculously low valued at the moment. So I mean, S4 Capital for me is a company that is doing really well, and doing really well in a very poor environment at the moment. And you look at it at £1.36. I mean, you should be talking, I mean, you're talking a company that should be, you know, easily £3. I've always said that for me, S4 Capital is a £5 stock, and then eventually in the longer term, we could see it pushing up to £10. We'll see what happens. It depends on future growth rates to just that valuation. But yeah, it looks really good, and hopefully we'll be okay with Martin Sorrell making a recovery. And even if he doesn't decides to, you know, step away from the business and someone else decides to come in, I'm sure with the financials and projections they have, I think they could easily deliver these financials. So yeah, I think this is a incredible steal at the moment. The next one's Airtel Africa. So most of you guys know I've mentioned this stock for a while on this YouTube channel. Absolutely fantastic company this is. It's a company that is very low valued at 8 times earnings and a 3.8% dividend yield. And the stock, originally this was a very good performer for me. You can see here through this time frame, you know, it's a stock that I could have been, if I did want to average up on it, I could have been over 300% up on Airtel Africa. But I've just averaged up. Averaging up. It's getting a bigger position for me because I look at the financials and the valuation it trades at, and it's just ridiculous. So it's getting a bigger position in my portfolio. And in the last kind of year, it's kind of flatlined a little bit at the moment. I don't think it deserves to be. I think this is a premium company. It should trade at premium valuation. It's not, and that's why I'm buying the stock at the moment. If you look at Airtel Africa, obviously what they're kind of focused on is 5G and 4G growth in Africa, which is absolutely huge at the moment. As well as mobile money, they have a mobile money platform as well, which is absolutely growing crazy as well. You look at the recent financials, they brought out very impressive recent financials as well. The growth was very good, and there was the only little downside to the actual earnings report was the profit was down a little bit, 5 million after a derivative loss of 245 million, and also higher FX at the moment, which is affecting the business at the moment. But that's not going to be a long-term issue in the company, and that will resolve in the longer term. And you know, you talk about a company that potentially goes from you know, 663 million in profit, 770 million in profit, 884 million in profit, growing the revenue at a really good, you know, high single digit, 10% potentially revenue growth at 8 times earnings. That dividend will also get hiked up going forward as well, as you can see what is a projection here. So I mean, you're picking up a company here at 8 times earnings with the growth in Africa for 4G and 5G for many years. You got the mobile money platform as well, two really good incomes for this business. Yeah, I really like this one at the moment. I think this is a really good opportunity. Next one's Hollywood Ball. So I did take a little bit of a nibble at Hollywood Ball. As you can see here, there was a little bit of weakness going on through the month of April for the stock. You can see from here it was having a bit of a downturn. Anytime there's like a 10-20% dip in Hollywood Ball, I do tend to pick up some shares because I really love this company. One of the best management teams that I own. 12 times earnings I still think is cheap. 4% dividend yield, which is a lovely dividend to pick up. Obviously, most of you guys will know Hollywood Bowl. They've got these bowling alleys. They even got the put stars as well, which is like the crazy golf. And they also tie them in with like arcades. They have bars, restaurants, or some food there, and they have really good incomes, and they put them in really good locations where you might go for something to eat, you might go to the cinema, then you go into Hollywood Bowl afterwards, and they've done very well. So the UK part of the business has done excellent over the last few years, and also they're expanding into Canada, which is really good. So you can see here the first group half revenue was up 10%, and you can also see that they're also extending into their Canadian part of the business as well, which they've now got their 10th centre already open, which is really good. The recent results were absolutely crazy, and yeah, I mean, obviously when you look at the growth of the business, being really good before the CV situation, they came out of the CV situation all guns blazing, you know, profit really high up, revenue really high up. I don't agree with this downgrade in the forecast of the profit. I think this will be a lot higher than what they're expecting as well. Financial health wise, you know, they've since the CV situation, they've really they had a good balance sheet, but they even strengthened it up through the CV situation, paid all the debt down, which is really good. Equity's going up, obviously that will be a lot of the acquisition from the Canada side of it as well, while the equity is going up. And obviously on the dividend point of view, they're getting towards the point of view where they were before the CV situation, so you know, you're going to have a dividend that gets hiked up as well going forward at the moment as well. So yeah, really quality business. Obviously I'd really like it Hollywood Bowl to be my biggest position, but it's it does have these dips and then it kind of rallies up a little bit. So yeah, we'll see what happens. Obviously, I've owned this stock for many years now. Obviously, it was a stock that I was buying in the whole kind of CV situation, and same again, you know, it's stock I could have been up nearly 100% on, but I just keep averaging up on it because I want to make more money on it and get that dividend more and more. So yeah, love this company. Next one's Barclays. So with Barclays, I'm going to keep this nice and brief because I've actually made a change to this position since I did buy it. So I'll talk about that in a little bit. The other one's Moonpig. So Moonpig is same again. This is a stock that I bought. The problem is since I bought it, the stock has been starting to rally up a little bit. So you can see here, it was about that £1 range and then it went up to the £1.35. So it's a bit of a rally up here. So I'm kind of like waiting to see if it has a little bit of a pullback. Moonpig itself, obviously, most of you guys probably have heard the site. Obviously, you can use it to send cards to people. Also, you can send gifts to people. That was actually one of the acquisitions that they made, which was buy a gift, and that's one of the expansions they've been making. The shares have really been dropping since the IPO, which happened in 2021, because it was a quite rich valuation when it came onto the stock market. But then since that time frame, obviously the peak of the CV situation, online business, everyone's kind of gone back to the high street for the cards, which has benefited another stock that I own, which is Card Factory. And now in the last kind of couple of months, I'm looking at this one going, okay, has this one been beaten down now? Has the tough CV comp started to come out of it? And that's what it's been really hurt about. It's been hurt because it took on this Moonpig acquisition, which a lot of people weren't a fan of because it did weaken the balance sheet a little bit, which they have said they're going to focus on paying down the debt, which is obviously one of the issues why the shares have dropped. And obviously on the growth point of view, they had a major boom from the CV situation, as you can see here, but now they've had the point of view where everyone's kind of gone back to the high street, and the profit and revenue has come a little bit flatter once again, and that's what's really hurt the share price. But I think, you know, if they can get this acquisition to work, pay down the debt, the growth starts coming back on the business now after these tough CV comps, and the profit starts going up. You know, if they start putting in 30-40 million in profit, you know, you talk about 10 times earnings, start growing up to a higher single digit range, strengthen the balance sheet. I think this is a good turnaround play where you might get this, you know, up to around about £2-ish, which would be not near the IPO price of £4, but it would be somewhere where they were a bit at the start of the year. So that's my aim on this one. It's a bit of a double up on the share price, but my preferred range is a bit towards the £1 range. So I bought some, but it's gone a little bit higher, so I'll sit back and see if it goes a little bit lower. But I'm buying a little bit of Moonpig at the moment. For Terrace, I have been buying a little bit of this one, 7 times earnings, 7% dividend yield at the moment. Most of you guys probably know this one. It's a play in the building sector, obviously like bricks, for example. And as you can see here, the thing is that in the UK, you know, even though we're having a situation where housing market's weak at the moment, it's not going to last forever. It's going to come back. You know, we have such a demand that we're so far behind at the moment that they are going to come back, and the housing market will come very strong again once this interest rate environment kind of calms down at the moment. And obviously London Brick is more of a picks and shovel play rather than an actual house builder, because they basically supply a lot of the house builders. You know, they make the London Brick, which goes into about 25% of the British homes at the moment. So yeah, it's a bit of an all-around play at the moment. They've been making a lot of investments, which I think will also pay off in 2024, 2025 when the housing market comes back. The example of that would be the new Desford facility that they've been doing at the moment. As you can see here, you got the likes of the new brick factory that's starting to happen as well, that's just started opening up actually, and also an investment into the brick slip manufacturing capability as well here in their Accrington facility as well. So all these investments really make me bullish for when the market comes back for this company, the housing market comes back, because they will be able to, when the demand gets really good, they'll be pushing out more and more products. And you can see here there's the dip at the moment that's going to go on the profit and revenue side of it. And you can see here, analysts and me myself think that this will start rebounding going forward. 44 million in profit, 51 million profit. Revenue starts increasing because of the new facilities they have as well. And it looks like an attractive valuation. So it's going to be a kind of choppy kind of 12 months. But when I think I look out the longer 12 months, I think this will really benefit as well. Very good balance sheet, as you can see here. They've got around 18% debt to equity as well. Obviously, from the dividend point of view, the dividend is under threat slightly because of the whole situation. We'll probably go around, you know, as the forecasts are here, to a 5.7% dividend yield. But that should go back to the higher rates once the market recovers. So you can weigh that up both ways, where you can say, oh, I will get that dividend, or even at 5% dividend yield it will still be very attractive, but in the longer term it should, you know, return back to good levels, which I'm really happy with. So yeah, that's a bit of a you got to be a bit patient I think with this one, but I think it should do well in long term. The other one is Supreme. This is a new stock into the portfolio. Same again, this is a bit of a value play with a dividend yield. I'm not actually going to talk about this one on this video just because these videos get really long and I don't want to spend too long on one stock for you guys. So yeah, Supreme is another stock that I bought, and if you want more details on that, you can see here I did a video called why I have started buying Supreme stock, which I did about 2 weeks ago. As you can see here, that is 11 minutes long, and we'll cover this stock in more detail than what I will do today. So if you want more information, you know, after this one, go watch that one maybe. And the last one was National Express's. It would be no surprise to you guys. We've covered about this one a lot on the YouTube channel. So same again, I'm not going to go into much detail about this one because I've covered it so many times and there's not really too much new information to talk about it. So I don't want to bang on all the information towards you guys, but obviously, you know, 4% dividend yield, winning major contracts. The revenue growth is very strong. The profits really starting to come back into the business here. Very good business that's doing very well, and it's basically the same levels it was in the CV situation, which is just absolutely bonkers to me because the company is nowhere near them sort of levels. When you look at the dividends back, the profits coming back, the revenue growth is going to be higher than where they were basically when the stock was £4.70. So obviously there's been a bit of share dilution since the time frame, so it's up to debate whether you say it's a £4.70 stock. But for me, I always thought National Express was around about a £3 stock. And actually, when it got to these sort of levels, I was actually selling National Express out for 100% return. So if it carries on going in this downtrend here, I'll just pick more shares up because I think it will go back to these levels, and I'll probably end up, you know, once again making around about 100% return on this business, even more, because at £1.18, a double up here would actually be £2.36. So quick maths there, £2.36, which obviously is easier to even get 100% return on, and also then I'll probably, when it does get to that point, I'll probably sell out half a position and then obviously keep the rest for that lovely dividend as well. So yeah, those are the stocks that I've been buying anyway. Hopefully I didn't overrun the video too much trying to squeeze all these stocks in. So as always, hope you enjoyed it. Hope the video is useful. If you could hit the like button, if you're new around here, subscribe, and let me know what UK stocks you've been buying as well in the comment section. Hope you enjoyed it. Catch you in a bit.